Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So what I want to do today is I want to talk about one of the companies that I own in this portfolio. When you have your own portfolio and you're managing it every single week, every single month, you're buying stocks, you're selling stocks, and you are doing your research, and because you want to add a new company to the portfolio and so on, what you normally tend to do, what I normally tend to do is make sure that company has a story behind it. What I mean by that is my thesis for this company is intact. So if the company goes down 5-10%, I will buy more of that company rather than sell it straight away. There will be some situations where you buy a stock and then the thesis change very quickly and you just sell out, just sell it to straight away. You might sell it on a loss or whatever, opportunity cost, whatever the case might be. And there are situations where you buy stock and you hold it for a long term. It goes down 10% because the thesis is still there. The company is a good business. There's a reason why it's in your portfolio. And what I mean by a reason is every single one of these companies basically has a reason why they are in my portfolio. Some are for growth oriented companies. So for example, ASML, it's one of the biggest company out there when it comes to having basically created those equipment that are used to make chips. Okay, they make basically the equipments themselves. No other company in the world, there are others, but they're not as big as this company, have access to that. So every single company like TSMC, for example, will not function today without the product this company creates. So for that reason, I know InshaAllah in the long run, this company will continue to grow as long as they continue to innovate. So they are the market leader when it comes to that sort of devices. So it's the growth as well as the dividends. Now the dividends is not a lot. They don't pay much. In fact, I'll show you now. I have not added this company to the portfolio for the dividends because they just paid me in February about £8.42. Okay, for the 8 shares that I own for this company. So it's absolutely non-existent when it comes to dividends. But if I was to sell today, I would make over £2,200 in profit. I'm up 50%, over 50%. So that's exactly what I mean. There are companies that are here for the growth. There are companies here for genuinely just for the dividends. Like companies like Rio Tinto, I'm holding this company, I'm buying more of it because of the dividends and so on. So what I would like to do today, guys, is to share with you one of the companies that I have in this portfolio that has not done well recently, but I want to show you the evidence to kind of expect basically what I see and the reasons why I'm buying more of this company. Before we get to that, if you can like the video, I would really appreciate that. Subscribe, of course, to the channel. Let me know if you have any questions. And of course, to join us on the Patreon account where you get access to all of these things, all the buys, all the sales that I'm making, and the private Discord where you can share with your thoughts in your portfolio and actually see what other people are buying, what are they selling, why are they buying it, why are they selling, and so on, so on, so. The company I want to talk about today is Medtronic. Medtronic is one of the companies in the healthcare side of things. They have equipment, so they are the equipment side of things. So they have equipment that deals with diabetes, cardiovascular, neurosciences, for example, others, and medical surgical. So these are the 5 sectors. These are the 4 main ones, but they have basically that they have. So it's about the recent revenue that came in the Q3 of 2024 is one of those companies that have already started reporting 2023, which is 2024, sorry, which is a bit weird. But yeah, so they have these are their main sectors of their business. So they've generated over $8 billion, and they were up from last year. But remember, last year they didn't do well. So it looks basically the revenue looks amazing. Yes, it's up and so, but it's not as much. One of the things I like about this company is how diversified geographically their revenue is. So in the United States, there's almost about 50%, and the rest that comes from Europe and other developed countries and emerging markets. So $2.4 billion of their revenue comes from Europe and other developed countries. Emerging markets is $1.5 billion, and the US is about 4 point something. So more than half of their business comes from basically half of their business come this year and this sector anyway, and this quarter came from basically the rest of the world, which is quite nice. The stock is only up 1.5% a year to date, and in the last 6 months, just almost the same, and for the 1 year is almost the same. So it hasn't really done much for this basically year. So let's have a look at in more details basically the information about this company in terms of the growth side of things, in terms of profitability and so on. So the company has a market cap of $111 billion. Current dividend yield is 3.3%, which is quite nice. And that dividend is very, very safe right now. Now, in terms of payout ratio, 52%, which is not high at all. Latest increase was almost flat, so 1.5%. They are dividend aristocrat because they have been increasing this dividend for 45 years. So another 5 years, they will become a dividend king. But for the 5 years is over 8%, basically 8%, which is quite nice. And for the last 20 years, about 13%. Again, very fast, growing that very fast. You'll get $2.76 for every share of this company that you own, and it seems undervalued at the moment because the current yield, which is 3.3%, is way higher than the 5-year average, which is about 2.5, basically 2.3. So it's way higher than basically where it historically has been, and the forward PE is actually lower than the 5-year average. So the 5-year was been 18, so that's where it's been trading over the last 5 years. In terms of PE side of things, right now is 15.6 basically, which is slightly lower than the healthcare sector, which is quite nice to see. Now, in terms of payout ratio, we've already seen about 52%. Next year is coming down to 51%, which is nice. Free cash flow payout ratio of right now is about 76. Next year is coming down to 56. Again, really good. Earnings per share has been going up, and then it was flat 2020 and 2021. Maybe it's a lot to do with COVID, and then since then it has bounced back and then kind of declined a little bit in the last 12 months. So it looks like it's bouncing back again in next 12 months. Earnings per share, free cash flow per share is also heading the right direction. When we look at the shares outstanding, the company has diluted the shares in 2015, 2016, and then since then they have been buying back their own shares or just keeping it the way it's been. They haven't bought back any of their shares. I'll show you a little bit more details of the shares outstanding in a second. Total sales is also heading the right direction. So last year was, 2023 was $31.2 billion. Right now, $32.3 billion. Now, talking about that, let's have a look at a bit more information. So looking at 2020, it was 28.9, and then it was 30, 31. Then in 2023, it was 31 again, 32. So a tiny decline between. That's why it's basically gone down quite a lot. But it looks like it will bounce back again. So $32.3 billion. Now look at this. The cost of that revenue. So $9 billion, $10 billion, $10 billion, 10 again about 11, and gross profit of basically 19. So this is before taxes and all of that stuff. Just bear in mind, after they paid all the taxes and everything they need to do, the net income is about 4.7, 3.6, $5 billion, 3.7 billion dollars, and $4.2 billion, which is not absolutely bad at all. Now looking at free cash flow, it was from $6 billion to right now about $4.9 billion, mind you. So 2020 is basically when 2021 when it's basically has a little bit declined because of the revenue was declining in 2020 because of COVID, and then it bounced back, and then in 2023 it has a decline a little bit again. The revenue went down, so for that reason, but it looks like it's bouncing back again from $4.5 billion to $4.9 billion. So for me, this is healthy. This covers the dividends. The company can reinvest in the business if they need to, and pharma companies actually grow non-organically because they do actually buy other companies or incorporate into their portfolio of basically devices that this company has. So moving on, return on equity, we're looking at about 8% right now. Return on invested capital almost as same as well, and 8%. Operating margins about 19%. A free cash flow margin of 15%, which is quite nice. Net debt to EBITDA right now we're looking about 1.72. Normally we're looking below 3. So like I said earlier, the company has reported their earnings recently. As you can see, they beat the top line and bottom line, both of them, and they guided basically better than what the streets were expecting. So they were expecting So they guided about 4.75 to the new range. Okay, so 4.75 to 5. That's basically what they said. The streets were expecting 2.79 a year, which is quite interesting. So they actually guided way higher. And then in terms of what that means, $5.13 to $5.19 to the new range of now $5.19 to $5.21 in comparison to what the streets were expecting, which was $5.16 basically. So it's about 4 cents more than where it should be. And in terms of revenue side of things, they're expecting about 2.9 to 3.3 in terms of revenue growth for the next year, which is quite nice to see. And we've already seen the growth side of it, but I'm just going to quickly show you again. Cardiovascular, basically for year-on-year change was about 6%. Medical surgical was about almost 4%, and then the rest, everything else in this quarter was actually looking nice. Okay, in terms of, if you look at the revenue for neuroscience, for example, it was almost a 5% year-on-year up, and diabetes was over 12%, which is nice. So absolutely no worries when it comes to what they've reported recently. Now let's have a look at the expectations moving forward, and then I'll show you the valuation side of things. Okay, so everything that I've seen so far is actually seems nice. 2024 they're expecting just a little bit of decline, and then 2025 it bounces back almost 5%, 7%, 8%, 8%, and then 15% if this one person is right. And then the following year, so 2024, again the revenue we select, this is what they showed us already. So that 3% expectations hopefully will happen. See what happens with that. And then 4%, almost 5%, 5%, 5%, again another 5%. So this is the type of business that grows about 5% to 10% in between that range, and this is what I call a foundational stock. So they are the foundation of every portfolio because they have a very low beta. They pay that solid, reliable dividend every single year. They grow that dividend because they are dividend aristocrat. They even talk about that because, and it's important when companies mention this in their revenue, I think they've talked about this, the fact that they are a dividend aristocrat and so on. So that means, okay, they don't have any plans to cut that dividend anytime soon. So let me see if I can find it. I think is the next slide. So they've talked about research and development, and there we go. 46 years of dividend increases, member of the S&P 500, dividend aristocrat. So to me, this means they're not going to cut anytime soon, and they're buying back their own shares. $4.4 billion shares are basically there since fiscal year of 2021. So since 2021, they have actually taken a lot of their shares off the market, which means every share of this company that you own is now worth more. Now let's go to Morningstar to show you the valuation is 25% discounted right now. $112 per share is where they think the price should be. The company, of course, has a wide economic moat. In terms of the trailing returns, this is where the company has not done well at all. So about 6% total return in the last 10 years. That's basically what we get. And moving forward, according to these guys in Yahoo Finance, next year they're expecting about 5% growth, and then basically every single year, 3.5% every single year moving forward. Now, going back to Seeking Alpha, let's go to the ratings. Let's click Wall Street and see what they're expecting. So about 13% upside from where we are now. $94 per share is where they think the price should be. Now, let me show you this. So this is what we're looking at. Okay, so Medtronic is the company that we're looking at today. So valuation we've seen already. Morningstar is $112 per share. Seeking Alpha $94 per share. Dividend yield, dividend discounted model that I used gave me $97 per share. The multiple valuations, so where I compared this company with the Stryker and the Abbott Laboratories, both very similar. All three of them are very similar in terms of what they do. So $124 per share. If you average out the four, you get $107 per share, and current stock price is right now $83 per share. That gives us difference of almost 28% from where we are now, which is quite nice. Now you might want to say, do you know what, I don't trust this company, I'm going to give myself 10% of margin of safety, which I suggest you always do. It's still 96%, $96 per share, which is basically higher than the current price, and it's still up by under that, of course. So again, this is a solid business. We've seen everything is heading the right direction. Again, it's not a market beater. In fact, I'm going to show you one of the major concerns for this company. If you're interested, of course, I'm going to add let me add a Striker, and I will add ABT as well. Okay, so these two companies, and I want to see if they've actually done better or not. So let me go on performance. I want to see total returns basically from these companies for the 1 year. Medtronic's about 5%, the S&P 500 we're looking about 30%. Striker's done really well, about 37%, and Abbott Laboratories about 20%. So it's lagging when it comes to these. 3 years is even worse because I've already seen it, minus 22%. Everything else basically here. Abbott was closest to here, but Striker's been really expensive. Striker's been on my watch list for so long, but it hasn't actually come down a lot. 5 years, about 3%. Again, they've all left it for dead. For the 10 years, about 40%. And S&P 500 and 173%. The Striker almost 400%, and Abbott 263%. So the company has not done in terms of returning a lot of money to shareholders in the last whatever years, but is one of those companies, is a steady Eddie company that's been steady Eddie for quite some time, and is one of those foundational stocks. That's the reason I own this company in my portfolio. Again, of course, if you're interested, you do your own research, but I do own the company in my portfolio, down about 7%. It was way higher than that, but it has bounced back. My average is about $89 per share. Right now it's $83 per share. I will continue buying this, inshallah, because I do think is one of the companies that in the long run, I just want to keep it in there and just let it grow. If I can get that 4-5% plus those dividends every single year in terms of price appreciation and so on, that if I can get that 7 to 10% every single year moving forward, inshallah, then I will be a happy man. Just like what I did with Merck. Merck's slightly different company, but it was undervalued so much at some point, and I've just hold on to it. So for now, it's good. Basically, for now, I'm going to hold on to it, add to it, inshallah, and I'll let you know what happens. Again, that's my take on this. Your take might slightly be different. Your opinion might be slightly different, and if that is, it's absolutely fine. That's why we're human. We're all different, alhamdulillah. So you do what you need to do what makes you happy, do what makes you comfortable. Go away and buy your Nvidia. If you're one of those people that are going to go to the comments and say, oh, this is a dead company, just do your Nvidia, buy your super micro computers and whatever else you need to do. I'll do me, and I'll do these companies. I'll buy these companies that I think are good for my portfolio, inshallah, in the long run. Anyway, let me stop here. Have a wonderful day. Assalamu Alaikum.